Stock prices are, are dropping right now, and while that might sound scary, it could actually be the silver lining we've been waiting for. Here is why these red numbers on Wall Street might soon lead to lower interest rates and what that could mean for your wallet. Hi, my name is Danholm, and I'm a real estate broker here in Central Florida. I have made it my mission to provide real actionable real estate advice, and sometimes that also crosses over into some other stuff like talking about markets and interest rates. And if you want to know more about how this current stock market crash, almost, I think some people have actually referred to it as a stock market crash. I would certainly call it a crash. Stocks have dropped quite a lot over the last week or so. You're definitely in the right place if you want to know how that could positively influence the interest rates. So it might make it easier for some people to buy homes here. But let's start with the basics. Stocks and interest rates may seem like they belong in totally different conversations, almost like in total different universes, but they're actually linked quite closely. Stocks represent ownerships in companies, as most of us know, and interest rates represent how expensive it is to borrow money or how much we get if we lend money to the banks or someone else. And when one of them moves, it often causes the other one to respond. Not a lot of people know that because it usually doesn't affect people that much. But when stock prices start to fall, it's often because investors are nervous about the economy. It could be what the future holds. If they are worried about the economy slowing down, they're worried about, in this case, in this current time, they're worried about tariffs and trade wars, and that fear spreads. And this is where things get really interesting, because when fear hits the stock market, interest rates often come down shortly after. It is almost like a chain reaction. Think of it like the economy catching a cold. The stock market starts sneezing, and so the Federal Reserve hands out medicine or a handkerchief, and that would usually be in the form of lower interest rates. And this pattern isn't just theory, it has happened over and over again throughout history. In fact, since 1929, 86% of the time that the Fed has cut rates for the first time during a cycle, the stock markets went up within the following year. That's right, more than 8 out of 10 times the market bounced back after rate cuts. So the Federal Reserve can definitely use interest rates to indirectly control the stock market. Now, it's true that it doesn't happen instantly and it doesn't happen all the time, but there's often a lag. First, the stocks drop, and then the Fed watches, and if the data supports it, they lower interest rates to support the economy, and the economy starts to recover, and eventually the stock market follows. Two exceptions throughout history. Obviously, there's always exception to any rule. In 2001 and 2008, when we had the dot-com bust and the housing crash. First one was the dot-com bust, and the second one was the housing crash. Those were pretty extreme cases. So normally, this cycle I just talked about is actually quite true. So how does the Federal Reserve decide when to step in? Well, their job is to keep inflation relatively low and employment relatively high. So when stocks are falling, it usually means businesses are struggling and hiring slows down and spending drops. So if they being the Fed, thinks that that slowdown could harm the economy, they respond by lowering interest rates to sort of boost everything again. So imagine that you're driving up a hill and your car starts to slow down. That's when the Fed steps in and presses the gas by cutting rates. Lower rates make it cheaper for businesses and consumers to borrow, which encourage people to spend either by investing in their business or spend more in the private economy, and that keeps the economy moving. But it's not just the Fed that makes rates fall. Investors themselves play a huge role in this, because during scary market moments like what we have now, when stocks are dropping like crazy, people shift their money in from what is perceived as more risky assets like stocks into more safer ones like government bonds. And that means they buy more of them, and that means that the interest rates drop. That's what economists refer to as flight to safety, which is what we can expect will happen over the next couple of weeks. So when tons of people rush into bonds, demand for these bonds go up, and that pushes their price up. And the higher the bond prices are, their yields or their interest rates, well, the lower they are, they go down. So that flight to safety actually drags interest rates lower, which is probably why one of the reasons that the Fed waits and sees what happens. Because if the market can self-regulate and lower interest rates by itself by people simply moving money from one asset to another, that means that they might not have to do anything. But it is a bit like everyone is running for shelter in a storm, and the price of that shelter ends up getting cheaper for the next person coming in. So let's get down to what really matters here. What does this mean for you? Well, that means that if this trend continues and the Fed do decide to lower rates, or investors keep piling into safer assets, we could see cheaper borrowing costs ahead. And that's pretty big news, because if interest rates go down, mortgage rates go down, because mortgage rates are interest rates. So lower interest rates make mortgage payments more affordable. They can reduce what you pay on credit cards, car loans, and student loans as well. But for homeowners, the most important thing is that lower interest rate means a better shot at refinancing. So if you bought within the last year or two and you buy at a relative high rate compared to what you could have bought to during COVID, you might actually see an opportunity now to refinance. Also, if you're thinking about buying, but you think the rate's a little bit high, it might mean that the rates that you would be paying on your new loan could go down over the next few weeks or months. So for buyers, it could mean that you could qualify for a bigger loan, or maybe finally afford the home that you've been dreaming of. Um, it also encourages more investment in business and houses and businesses and housing, and that could boost job creation that could raise wages and get the economy humming again. So a lot of things could happen over the next few months. It might not all happen overnight, but when rates fall, opportunity rises. And when stocks fall, rates fall, as a general rule. Because, of course, no trend is 100% guaranteed. Sometimes inflation can get in the way. If prices are still climbing too fast, the Fed may hesitate to cut rates, even in stocks, if in a situation like this when stocks are sliding. But in many cases, especially when inflation seems to be under control, falling stocks are a clue that lower rates might be just around the corner. So the question now is, what should you do today? Well, first of all, stay calm and keep busy. No, don't panic if the market dips. History shows that rate cuts often follow, and that creates opportunity as a home buyer, whether you own your home and just want to refinance, or if you just want to buy a new home. Secondly, maybe prepare. If you've been thinking about buying a home, this could be your window. So talk to a lender now to get pre-approved, and be ready to move quickly if rates do drop. Because remember, if you get whatever you're approved for now, if rates drop, you could probably be approved for a little bit more when they drop. And thirdly, if you already own your home and you think your rates are a little bit high, do not ignore the chance to refinance. Even a 1% drop in your mortgage rate could save you thousands over time. So it's definitely worth considering. So this is the time to play offense, not defense. Educate yourself, make a plan, and keep your long-term goals in focus. That's what I would advise right now. So if this, what I would call kind of down-to-earth financial info, helps you, please don't hesitate to hit that subscribe button and turn on the notification bell. The subscribe button tells me that you like my content. The notification bell ensures that you get to see next time I upload new videos. And if you could also take just a fraction of a second and hit the thumbs up, that would be great too, or maybe comment below, because that keeps me going and that keeps more content coming your way. So what do you think? Do you personally think that we'll see interest rates fall soon? And if they do, if you're thinking about buying a home, what would you use your savings for? Would you use it for a home upgrade? Would you use it for maybe saving a little bit of money on the home that you were planning on buying anyway? Let me know in the comments below. I would love to know what your thoughts are and what's going on in your world. And I do read every single comment myself, and I comment on them as well. I respond to them. So if you want to know, if you want to talk to an mortgage lender and you don't really know anybody, well, give me a call, send me a text, or just hit me with a comment, and I will happily refer you to somebody who can help you with the next step. Remember, And this is definitely one of these times. Sometimes good news could be hidden inside the bad headlines. Thank you so much for watching, and I hope to see you in my next video. Until then, stay smart, stay calm, and keep moving forward. Thank you so much for watching. Have a great day. Bye for now.